Alright, imagine this: you've got a crisp $1,000 bill in your hand, and you're wondering, what's the smartest move for this cash? Now, imagine you could ask Warren Buffett, the Oracle of Omaha himself, that very question. How would he, one of the wealthiest and most successful investors in history, approach investing just $1,000 today? It's a fascinating thought experiment, because while he manages billions, his core principles are surprisingly accessible. We're going to deep dive into exactly what Buffett's blueprint would look like, from his foundational advice to the specific actions he'd likely take. Before we get into the nitty-gritty of where that $1,000 would go, we need to understand the bedrock of Buffett's investment philosophy. He's not about chasing hot trends or making risky bets. His approach is rooted in patience, discipline, and a deep understanding of what you own. He famously said, "Only invest in what you understand." This isn't just a catchy phrase, it's a guiding principle that steers him away from complex, opaque businesses and towards simple, predictable ones with durable competitive advantages. It's about buying a piece of a great business, not just a stock ticker. Okay, so you've got $1,000. But before Buffett would even think about buying a stock, he'd tell you the single best investment you can ever make isn't in the market at all. It's in yourself. This means improving your skills, expanding your knowledge, and enhancing your personal earning power. Think about it: a stronger skill set or a new certification can lead to a higher salary, which then allows you to save and invest more than that initial $1,000. It's about building the foundation for future wealth creation, not just a one-off trade. This might not sound like typical stock advice, but it's pure Buffett. Following on from investing in yourself, the very next step, and frankly, a non-negotiable for Buffett, would be to tackle any high-interest debt. We're talking credit card debt, payday loans, anything with an APR that's eating away at your financial future. Why? Because the interest you're paying on these debts is often far higher than any reasonable return you could expect from the stock market. If you're paying 18% on a credit card, clearing that debt is an instant, guaranteed 18% return on your money, a return you just can't get reliably anywhere else. It's financial common sense, which Buffett champions. Before a single dollar goes into the market, even with just $1,000, Buffett would insist on a solid emergency fund. Life throws curveballs, right? Car repairs, unexpected medical bills, job loss, these things happen. An emergency fund, typically 3 to 6 months' worth of living expenses, prevents you from having to sell investments at an inopportune time, or worse, racking up more high-interest debt. It's your financial safety net, and it provides peace of mind. Without it, even a small market downturn could force your hand, undermining any long-term strategy. That $1,000 might just be the start of this crucial fund. So, let's say you've invested in yourself, tackled high-interest debt, and you've got an emergency fund cooking. Perhaps that $1,000 was a starter for that. Now, if you still have $1,000 specifically for market investing, Buffett's approach here would be surprisingly simple and incredibly powerful for beginners. He understands that for many, $1,000 isn't enough to build a diversified portfolio of individual stocks like Berkshire Hathaway does. That's why he's consistently advocated for a specific type of investment for the average person, especially with smaller sums. What would it be? Drumroll please, a low-cost S&P 500 index fund. Yes, it sounds almost too simple for the Oracle of Omaha, doesn't it? But this is precisely his advice for most people, most of the time. He said it repeatedly: put 90% of your money into a low-cost S&P 500 index fund. Why? Because it offers instant diversification across 500 of America's largest companies. You're not trying to pick winners, you're betting on the overall growth of the U.S. economy. For a mere $1,000, you gain exposure to giants like Apple, Microsoft, Amazon, and Google, without having to buy individual shares. It's brilliant in its simplicity. Now, you might be thinking, Buffett picks individual stocks, why shouldn't I? And that's a fair question. The reality is, Buffett has entire teams of analysts and decades of experience dissecting financial statements, management teams, and competitive landscapes. For the vast majority of individual investors, especially with a modest sum like $1,000, trying to replicate that level of analysis is not only impractical but often counterproductive. The fees, the time commitment, and the high probability of underperforming the market make individual stock picking a trap for many. He knows his strength, and he knows ours are different. Let's back this up with some numbers, because Buffett loves numbers that prove a point. Historically, the S&P 500 has delivered an average annual return of around 10 to 12% over many decades. This isn't a guarantee for the future, of course, but it's a powerful track record. To give you perspective, if you had invested $1,000 30 years ago and earned an average 10% annual return, without adding another dime, that $1,000 would now be worth over $17,000. That's the magic of compounding, and it's why Buffett emphasizes holding for the long term. It beats almost any other passive investment strategy. In today's economic climate, with inflation hovering around 3 to 5% annually, simply saving cash under your mattress is a losing game. Your purchasing power erodes every single day. This is a crucial point for Buffett, who always thinks about preserving and growing real wealth. The S&P 500, with its historical average returns, offers a powerful antidote to inflation. It allows your money to work harder than the rate at which your costs of living are rising, helping you not just keep pace, but actually get ahead. Cash is king for short-term needs, but a long-term destroyer of wealth when inflation is rampant. What if you have more than just $1,000 coming in over time? Buffett would certainly advocate for dollar-cost averaging. This is the strategy of investing a fixed amount of money at regular intervals, regardless of market fluctuations. With just $1,000, you're making one lump sum investment into an S&P 500 fund. But as you save more, say $100 or $200 every month, consistently putting that into the fund means you buy more shares when prices are low and fewer when prices are high. This smooths out your average purchase price over time and reduces the risk of trying to time the market, which Buffett advises against for everyone. Alright, so you're sold on the S&P 500 index fund. But which one? Buffett would steer you towards a fund from a reputable provider known for low expense ratios. We're talking Vanguard, Fidelity, Schwab, companies like that. The low-cost part is critical, because even a difference of 0.5% in fees can eat significantly into your returns over decades. For $1,000, you'd likely look for an ETF, exchange-traded fund, like VO, Vanguard S&P 500 ETF, or SPY, SPDR S&P 500 ETF Trust, because they trade like stocks and have very low minimums. No need for fancy, high-fee managed funds. One of the hardest, yet most fundamental, aspects of Buffett's investing strategy, especially with a small sum, is patience. He famously said, "Our favorite holding period is forever." With $1,000, you're not going to get rich overnight. You're planting a seed. The real magic happens over decades, as that 10 to 12% annual return compounds year after year. Watching your initial $1,000 slowly grow to $2,000, then $4,000, and so on, requires an incredible amount of discipline to resist selling during market downturns or chasing short-term gains. This is where most people fail, not because of a bad strategy, but bad behavior. Even when discussing index funds, Buffett's concept of a moat is relevant. A moat, in his terminology, is a sustainable competitive advantage that protects a company's profits and market share. Think of companies like Coca-Cola with its brand power, or American Express with its unique network. While an S&P 500 fund diversifies across many businesses, the reason the S&P 500 has historically performed so well is because it's largely comprised of companies with strong moats. You're investing in the collective strength of these businesses, whose advantages allow them to consistently generate earnings and weather economic storms. Just as important as what Buffett would invest in is what he would absolutely avoid, especially with a modest $1,000. Forget about penny stocks, speculative cryptocurrencies, or trying to day trade. These are essentially gambling, not investing. He's always emphasized that investing should be rational and based on fundamental value, not hype or emotion. With $1,000, the temptation to chase quick, massive returns is strong, but it's a surefire way to lose your capital. Buffett's philosophy protects against this. It encourages you to think like an owner, not a gambler. Another crucial Buffett concept is the circle of competence. This means staying within the boundaries of what you truly understand. If you're investing in an S&P 500 fund, you're implicitly investing in a diverse range of companies that, on aggregate, fall within a broad understanding of the U.S. economy. You're not trying to become an expert on every single one, but you understand the general premise of what they do. With $1,000, it's about not overextending yourself into complex industries or businesses that you simply don't grasp. Stick to simplicity. It's easy to feel like $1,000 isn't enough to make a difference in investing. But Buffett would argue against that defeatist mindset. That $1,000 isn't just $1,000, it's the start of a habit. It's the first brick in a wall that, over time, can become a formidable structure. The act of making that first investment, understanding the principles, and committing to the long term is more valuable than the initial sum itself. It instills financial discipline and lays the groundwork for future, larger investments. Think of it as a down payment on your financial future. This is a classic compare scenario, and Buffett firmly falls on one side. Trying to predict market peaks and troughs, market timing, is a fool's errand. Even professional investors rarely succeed consistently. Instead, he advocates for time in the market. This means getting your $1,000 invested and letting it ride for years, even decades. The longer your money is exposed to the market's upward bias, the greater your chances of success, thanks to compounding. Don't sit on the sidelines waiting for the perfect moment, it almost never comes. Just get in and stay in. Investing isn't just about numbers, it's profoundly behavioral. Fear and greed are powerful emotions that can derail even the best strategies. When the market dips, fear can compel people to sell at a loss. When it soars, greed can tempt them into chasing overvalued assets. Buffett, with his steady demeanor, exemplifies emotional discipline. He advises being fearful when others are greedy, and greedy when others are fearful. With $1,000, it's easy to get swayed by daily headlines. Resisting that urge and sticking to your long-term, diversified plan is paramount. What's the real cost of not investing that $1,000, or delaying it? Let's quantify it. If you procrastinate for just 5 years, assuming that 10% average annual return, you'd miss out on potential growth. That $1,000 that could have become nearly $1,610 in 5 years, would stay $1,000. Over 20 years, it's the difference between $6,727 and $1,000. And over 30 years, it's a staggering $17,449 versus $1,000. These are not small numbers. The biggest mistake many young investors make isn't choosing the wrong stock, it's choosing to do nothing at all. The opportunity cost is immense. While $1,000 might not generate huge dividends initially, a key part of Buffett's long-term strategy, and a feature of S&P 500 index funds, is dividend reinvestment. Many companies within the S&P 500 pay dividends, which are essentially small portions of their profits distributed to shareholders. By setting up your fund to automatically reinvest these dividends, you use that money to buy more shares of the fund. This creates a powerful compounding loop, as those new shares then generate their own dividends, accelerating your growth over time. It's a passive way to add fuel to your investment fire. Buffett consistently champions simplicity. He often states that you don't need to be a rocket scientist to be a successful investor. In fact, he argues that sometimes, too much intelligence or overthinking can be a hindrance. His advice for $1,000 reflects this: don't try to outsmart the market. Don't get caught up in complex financial products you don't understand. A simple, diversified, low-cost index fund is often the most sophisticated strategy precisely because of its simplicity and effectiveness. It removes ego and emotion from the equation, allowing the power of the market to work for you. The biggest takeaway for that $1,000 investment, or any investment following Buffett's principles, is the unwavering focus on the long game. We're talking decades, not months or years. He views stocks not as pieces of paper to be traded, but as ownership stakes in real businesses. And real businesses grow and evolve over long periods. Your $1,000, through the S&P 500, becomes a tiny slice of corporate America's innovation, resilience, and growth engine. This long-term perspective is what differentiates true investing from speculation, and it's the bedrock of compounding wealth. In today's interconnected world, social media and constant news cycles amplify FOMO, fear of missing out, and FUD, fear, uncertainty, doubt. A hot stock pops, and everyone rushes in. The market dips, and panic sets in. Buffett, however, operates on a completely different frequency. He ignores the noise. His $1,000 strategy, anchored in a diversified index fund, is immune to these short-term psychological traps. You're not trying to beat the market's daily gyrations, you're simply participating in its long-term upward trajectory. This emotional detachment is a superpower in investing. For Buffett, the true measure of investment success isn't daily portfolio swings, but your financial progress over a lifetime. Did your $1,000 investment, coupled with consistent savings and smart decisions, contribute to a financially secure future? That's the goal. With just $1,000, it's easy to dismiss its potential, but by adhering to his principles, self-investment, debt elimination, emergency fund, and then a low-cost S&P 500 fund held for the long term, you're laying the exact same foundation that has built immense wealth for countless others. It's about starting correctly, not starting big. Buffett has been a vocal critic of high-fee active management, especially for individual investors. He famously made a $1 million bet that an S&P 500 index fund would outperform a basket of hedge funds over 10 years, and he won. The fees charged by active managers, often 1 to 2% annually plus performance fees, create an enormous hurdle to overcome. For someone with $1,000, these fees would be disproportionately destructive. A low-cost index fund, with an expense ratio as low as 0.03%, ensures that more of your money is working for you, rather than for the fund manager. Let's dig a little deeper into dividends. While your initial $1,000 might yield modest dividend payments, their cumulative effect over time is incredible, especially when reinvested. For example, if the S&P 500 yields, say, 1.5% in dividends, your $1,000 would earn $15 in the first year. Reinvesting that $15 adds to your principal, and then that new principal earns dividends. This snowball effect, combined with capital appreciation, is a major driver of long-term returns. It's essentially free money that you put back to work, building wealth silently and steadily without any effort on your part. Buffett is a master at tuning out the noise. Daily market fluctuations, economic forecasts, talking heads on TV, he largely ignores it all. His focus is on the underlying business value and the very long term. For your $1,000 investment, this means understanding that short-term volatility is normal, even expected. Don't check your portfolio every day. Don't panic when there's a dip. Remember, you're buying a piece of America's best companies. Their ability to innovate and generate profits isn't going to vanish overnight because of a news cycle. Stay calm, stay invested. Albert Einstein reportedly called compound interest the eighth wonder of the world. And Buffett absolutely agrees. It's the engine that turns small, consistent investments into substantial wealth over time. Your $1,000, growing at 10% annually, earns $100 in the first year. In the second, it earns $110, 10% of $1,100. That extra $10, earned on your earnings, is the magic. The longer you let this process work, the more dramatically your wealth accelerates. It's not linear, it's exponential. This is precisely why starting early, even with a small amount, is so critical. Buffett would also consider the tax implications. For your $1,000, placing it into a tax-advantaged account like a Roth IRA, if you're eligible, or a traditional IRA would be ideal. These accounts allow your investments to grow tax-deferred or even tax-free, which supercharges the power of compounding. If you don't have access to these, or have already maxed them out, a standard taxable brokerage account is still perfectly fine. The key is to start, and then optimize. But always prioritize those tax advantages where possible. They are a huge gift from the government for long-term investors. What happens when the market inevitably dips, as it always does? Buffett sees downturns not as crises, but as opportunities. When others are panicking, he's looking for value. For your $1,000 in an S&P 500 fund, this means that during a dip, you're effectively buying more shares at a lower price if you continue dollar-cost averaging. Even if it's just a single $1,000 investment, resisting the urge to sell allows you to ride out the storm, knowing that historically, the market has always recovered and gone on to new highs. This resilience is a core Buffett trait. Buffett's true investor's edge isn't some secret formula, it's a combination of temperament and a long-term perspective. He has the emotional fortitude to stick to his guns when everyone else is losing their heads. He possesses the patience to wait for years, even decades, for his investments to bear fruit. And he understands that financial markets are inherently irrational in the short term, but rational in the long term. For a $1,000 investor, cultivating these same qualities is your ultimate competitive advantage. It's not about being smarter, but being wiser and more disciplined. Let's quickly touch on alternatives. Gold? Buffett isn't a fan for investment purposes. He famously said it has no utility and just sits there. It doesn't produce anything. Real estate? While he understands its value, especially for cash flow and leverage, $1,000 isn't getting you into real estate directly. A diversified S&P 500 fund, however, does give you exposure to companies that own vast amounts of real estate, e.g., retailers, logistics firms, or extract natural resources. So, while these asset classes have their place, for a starting $1,000, the index fund remains king. While Buffett often focuses on American companies, the S&P 500's constituents are global players. Companies like Apple, Coca-Cola, and Microsoft generate significant portions of their revenue internationally. So, even though you're investing in a U.S. index fund, you're implicitly gaining exposure to global economic growth. This provides a layer of diversification beyond just domestic markets. For a $1,000 investment, trying to directly invest in international markets or specific foreign companies adds complexity and potentially higher costs that aren't warranted. The S&P 500 delivers that global reach efficiently. Buffett is famous for learning from his mistakes, and he encourages others to do the same. Even with an S&P 500 fund, you'll see ups and downs. The mistake wouldn't be in buying the fund, but in selling it prematurely out of fear, or trying to time the market. Learning to ride out volatility, to resist the urge to do something, is a powerful lesson. Your first $1,000 investment is a classroom. Every market cycle, every piece of news, every personal urge to buy or sell, offers an opportunity to refine your emotional discipline and reinforce your long-term conviction. Don't be afraid to make small missteps, but learn from them. Perhaps the most counterintuitive, yet profoundly Buffett-esque, piece of advice for a $1,000 investment is the power of doing nothing. Once you've invested that money into a low-cost S&P 500 index fund, and you've committed to the long term, often the best thing you can do is nothing at all. Resist the urge to tinker, to rebalance too frequently, or to jump between funds. Trust the process, trust the market's long-term upward trend, and let compounding do its magic. Inertia, in this specific case, becomes a virtue, not a vice. It saves you fees, stress, and prevents behavioral errors. Ultimately, what would Warren Buffett be doing with that $1,000? He wouldn't be looking for a quick flip or trying to impress anyone. He'd be laying a brick. He'd be planting a seed. He'd be demonstrating the exact same disciplined, long-term, value-oriented approach that he applies to billions. That $1,000 isn't just money, it's a statement of intent. It's your commitment to financial literacy, to fiscal responsibility, and to leveraging the incredible power of capitalism for your own future. And that, my friends, is why even a small sum, handled with Buffett's wisdom, can make all the difference. Let's quickly recap Buffett's likely blueprint for your $1,000, in order of priority. First, invest in yourself. Second, pay down any high-interest debt. Third, establish or bolster an emergency fund. Only then, once those foundational elements are in place, would he suggest investing in a low-cost S&P 500 index fund. And once it's invested, the crucial final step is to hold it for the long term, allowing compound interest and the collective strength of America's greatest companies to work their magic. It's a testament to his practical, no-nonsense approach to building wealth. What we've explored today isn't some secret trading hack or a get-rich-quick scheme. It's the timeless wisdom of one of the greatest investors to ever live, distilled down to a practical plan for even the most modest starting capital. Buffett's enduring message is that successful investing isn't about being brilliant, it's about being rational, patient, and consistent. It's about understanding the power of compounding and avoiding common behavioral pitfalls. Your $1,000, handled with this wisdom, truly has the potential to be the start of something significant. So, there you have it, Warren Buffett's likely blueprint for investing $1,000 today. It's not flashy, but it's effective, grounded in decades of proven success. This approach empowers you, the individual investor, to participate in the growth of the global economy without needing to become a financial wizard. What are your thoughts? Would you follow Buffett's advice, or would you take a different path with your first $1,000? Let us know in the comments below. And if you found this deep dive valuable, don't forget to like this video and subscribe for more insights into smart, long-term investing strategies. Thanks for watching.